Well, it looks like Toys R Us is no more. The color-coordinated children's store, with pink aisles for dolls and camo aisles for G.I. Joe, will cease all operations. Unless a white knight appears between now and March 29th, they will close their door for the last time on that day. Today, a look at the sad story of the leveraged buyout of Toys R Us. Welcome, it's Friday, March 16th, and this is ValueSide. I'm your host, David Ravel. Well, just the name, Toys R Us, was enough to light up the eyes of any 5-year-old. In the days ahead, I'm sure a lot will be written about the fond memories that this iconic toy store generated. The modern financial story of Toys R Us really began back in 2005, when two private equity firms, KKR & Company and Bain Capital, combined with Vornado Realty to take Toys private. It seemed like the perfect group for this strategy. Both Bain and KKR were renowned for their turnaround capabilities, and add Vornado to manage the real estate holding of Toys R Us, and you seem to have a winning combination. Unfortunately, the three had apparently underestimated the full impact of the big box stores and the online retailers in their ability to also distribute toys. And in the end, Toys R Us sold only about 10% of the total toy sales in the country. They were passed in their distribution by both Walmart and Target, which together controlled about a third of the market, and Amazon was gaining quickly in market share. Even JCPenney, the beleaguered retailer, has recently made a major move into the toy market, as they no doubt saw the trouble ahead for Toys R Us. Because Toys R Us is a private company and has been since 2005, we have no current financial data on the company. But by piecing together some of the company's recent announcements, we can get a rough idea of where the company stood. So back in 2005, the three investment partners, KKR, Bain, and Vornado, won a bidding war and purchased Toys for $6.6 billion. The majority of that capital was likely debt, and because of the status of Toys, they probably paid interest at the junk bond rate. That's assuming that the debt was all long-term. Hard to know for sure, but this is the most conservative estimate. We also know that Toys had a debt of $5 billion when they announced bankruptcy yesterday. So putting that all together, $5 billion in debt, likely junk bond status for interest rate, currently that would be about a 6% range, gives an annual debt service of $300 million per year. Take that over the 12 years that Toys was private, and you have a debt service load of $3.6 billion. That's a huge burden for a company that was just barely staying afloat. Now, because Toys R Us is private and we don't know whether this alone was enough to sink the company, but it sure didn't help. And what's more, interest rates are now rising, so that $300 million per year in debt service was almost certain to rise. And for that reason alone, this may have been the best time to throw in the towel. And unfortunately, this example of high debt and rising interest rates is likely to see more victims. Just yesterday, iHeartRadio also declared bankruptcy. Well, today we have several retailers and smaller capitalized companies reporting on their earnings. On the retail side are Tiffany's, the iconic jewelry company which operates 313 stores around the country, Perry Ellis, the maker of fine clothing for men and women, Kirkland's, which operates 400 home decorating stores, and Hibbett's sports stores. Also reporting will be Future Fuels, the producer of specialty biofuels, and finally, Houston Wire and Cable, all reporting today. Now on the economic front, several important reports are due out. At 8:30 this morning, new housing starts will report, expected to show a slight decline over their January numbers, and at 9:15, both industrial production and capacity utilization will also be announced. Both are expected to show slight gains as the manufacturing sector continues to exhibit strength. And at 10 o'clock, we expect to get 3 reports, Job openings, which have been showing some strength lately, up 4.9% in the year ended January. That is somewhat offset by the labor turnover survey, which saw a 5.6 annual increase in workers quitting last month. Finally, we get the Michigan Consumer Sentiment Index, expected to decline slightly from a very high 99.7% last month. And that brings you up to date on the investment markets for today. We'll be back tomorrow to see how we did. This has been a copyrighted edition of ValueSide, published before the opening of the New York Stock Exchange for Friday, March 16th. Don't forget, you can hear ValueSide on Google Music, SoundCloud, iHeartRadio, and in the Apple iTunes Store. For all of us at ValueSide, I'm David Ravel, hoping you have a great day.